Most people believe the transition from employee to investor is marked by a financial milestone, a certain net worth, a first profitable portfolio, passive income surpassing salary. Books written by those who have actually made this transition tell a far less dramatic and far more useful story. The real shift happens long before the numbers change. It happens in how decisions are made, how risk is understood, and how time is valued. Employee thinking is shaped by predictability. Effort is exchanged for income on a fixed schedule. Performance is rewarded within defined boundaries. Responsibility is limited to a role. Books that explore the investor path begin by showing how deeply this framework imprints itself on behavior. Even high earners often remain employees in mindset long after they begin investing because they continue to seek certainty where none exists. The earliest lesson these books emphasize is that investing is not an extension of employment. It is a fundamentally different game. Employees are rewarded for consistency. Investors are rewarded for judgment. Employees optimize effort. Investors optimize allocation. Confusing these two leads to frustration, impatience, and poor outcomes. One of the most powerful insights repeated across these books is that the employee to investor shift begins with how risk is perceived. Employees are trained to avoid risk because risk threatens income stability. Investors accept risk as unavoidable and focus instead on managing exposure. This difference shapes everything. Employees ask, "Is this safe?" Investors ask, "What happens if I'm wrong?" Books show that many people fail at investing, not because they lack intelligence, but because they carry employee expectations into investor environments. They expect linear progress. They expect effort to correlate with results. They expect feedback to be immediate. Markets violate all of these assumptions. Learning to tolerate delayed feedback is one of the hardest psychological adjustments on the path. Another recurring theme is time asymmetry. Employment pays quickly and predictably. Investing pays slowly and unevenly. Early on, this feels deeply discouraging. Books describe years where progress felt invisible, where returns were modest or non-existent, where discipline was tested without reward. Those who succeeded did not outperform early, they endured early. These books also stress that becoming an investor does not mean quitting work. In fact, many of the most successful investors remained employees longer than expected. Employment funded learning. Salaries reduced pressure. This stability allowed better decisions. The transition is not about escape, it is about optionality. Another critical lesson concerns cash flow. Employees often underestimate how much stability matters early in the journey. Books emphasize building buffers before chasing returns. Emergency funds, low fixed expenses, minimal debt. These are not conservative habits. They are enablers of intelligent risk-taking. Without them, investing decisions become emotionally compromised. Books on this transition also focus heavily on education, but not in the way most people expect. They caution against starting with stock tips or complex strategies. Instead, they emphasize understanding basic mechanics, compounding drawdowns, diversification, and behavioral bias. Investors who skipped these fundamentals often learned them later at great cost. Another recurring insight is that identity must shift before income does. Employees often define themselves by role title or employer. Investors define themselves by process. Books describe how this identity change affects decision-making. Investors detach self-worth from outcomes. A bad quarter does not feel like personal failure. This emotional separation is essential for longevity. Risk tolerance is redefined in these books. Employees often believe they are conservative because they fear loss. Investors learn that refusing to take any risk guarantees erosion over time. Inflation opportunity cost and stagnation become visible threats. The investor mindset seeks controlled exposure rather than safety illusions. Another theme appears around patience with boredom. Investing is often dull. Long stretches of inactivity are normal. Employees are accustomed to busyness being rewarded. Investors learn that inactivity can be strategic. Books repeatedly note that many mistakes came from acting out of discomfort rather than necessity. These books also challenge the myth of passive income as effortless. While investing can reduce time for money exchange, it demands mental discipline. Asset allocation rebalancing and emotional control require attention. The work shifts from activity to oversight. Underestimating this responsibility leads to disappointment. Mentorship appears differently here as well. Employee mentors teach skill and advancement. Investor mentors teach restraint and survival. Books show that those who sought feedback during uncertainty, not just during success, progressed faster. Learning to listen without defensiveness became an advantage. Another insight is that progress is rarely linear. Drawdowns occur. Strategies fail. Markets change. Books emphasize adaptability over conviction. Investors who survived long-term were willing to revise views without abandoning principles. Flexibility compounded more reliably than brilliance. As capital grows, so does responsibility. Investors influence not just personal outcomes, but family stability and future opportunity. Books show that this awareness changes behavior. Recklessness loses appeal. Preservation gains respect. The goal shifts from maximizing returns to sustaining independence. Over time, readers notice a quiet change. Employment becomes less central emotionally. Income from work feels additive rather than essential. Decisions feel calmer. Time horizons lengthen. This is the moment the investor identity begins to solidify, not with celebration, but with subtle relief. And this is where the story begins to narrow. Because once the journey from employee to investor is understood not as a leap, but as a gradual rewiring of expectations, habits, and identity, the fear around it diminishes. The path stops feeling like a gamble and starts feeling like a process. Slow, uneven, and deeply personal, guided not by shortcuts, but by patience, learning, and the willingness to let capital work quietly, while you continue to grow into the role that ownership demands, like letting go of the need for certainty. And this is where books about the employee to investor journey reveal their quiet conclusion. In the second half of these books, the transition becomes less visible and more internal. There is no dramatic resignation letter, no sudden declaration of freedom. Instead, there is a subtle shift in how uncertainty is handled. Employees experience uncertainty as a threat to stability. Investors experience it as a condition to be managed. This shift alone explains why two people with identical portfolios can experience radically different outcomes over time. One of the most repeated lessons is that the moment you truly become an investor is not when investment income replaces salary, but when you stop needing immediate validation from results. Employees are conditioned to expect feedback, weekly paychecks, performance reviews, promotions. Investors must operate without applause. Months or years can pass without clear confirmation that decisions were correct. Books emphasize that those who could tolerate this silence gained an enormous advantage. Another uncomfortable truth appears here. Many people accumulate assets, but never leave the employee mindset. They panic during drawdowns. They abandon strategies prematurely. They seek reassurance from headlines and peers. Books describe this as the half-transition financially invested psychologically employed. These individuals experience the stress of both worlds without the benefits of either. The books also show that investors learn to redefine success. Employees measure progress by effort and recognition. Investors measure progress by positioning. Are they exposed to long-term growth? Are risks survivable? Are options increasing rather than shrinking? This redefinition reduces anxiety and improves patience. Another key insight is that the investor mindset is future-weighted. Employees are trained to optimize for the present pay period. Investors sacrifice present comfort for future flexibility. Books stress that this trade-off must be conscious. Without clarity, delayed gratification feels like deprivation. With clarity, it feels like strategy. As readers move deeper into these narratives, they notice how investors treat downturns differently. Losses are not interpreted as failure, but as tuition. Volatility becomes expected. The question shifts from, "Why is this happening?" to, "How does this change allocation?" This analytical distance protects capital and mental health simultaneously. The books also highlight a critical emotional transition responsibility without blame. Investors accept that outcomes are theirs to own, even when external forces dominate. This acceptance is liberating. It eliminates resentment and replaces it with agency. Complaints give way to adjustment. Another recurring lesson is that independence grows gradually. First comes financial breathing room, then decision flexibility, then psychological freedom. Books show that these stages rarely arrive together. Impatience at early stages often sabotages progress. Those who respected sequence advanced further. Over time, the employee-to-investor transition reshapes daily life. Time feels different. Urgency decreases. Decisions are less reactive. Career choices become optional rather than compulsory. Even for those who continue working, work becomes a choice rather than an identity. And this is where the journey resolves. Becoming an investor is not about escaping work or predicting markets. It is about learning to think in probabilities, act with restraint, and accept delayed outcomes without emotional collapse. The books that show this path do not promise speed. They promise durability. If this reflection resonated with you, pause and ask yourself one honest question. Do your financial decisions still require certainty to feel safe, or can you operate calmly in uncertainty? That answer tells you how far along this path you truly are. Share what this made you reconsider. And if you want to continue exploring books and ideas that guide the transition from effort-based income to ownership-based thinking, subscribe and stay connected. Because the most important career shift many people never make is not changing jobs, but changing how they think about money, risk, and time.